Hello, welcome back to Josh Delozier Investments. It's May 24th, 2025. Talking about fundamental analysis today. We got security analysis, another book I just added to my on sale items at Josh Delozier Investments. It's written by Benjamin Graham. I give it a 10 out of 10. That with the intelligent investor are must reads. Today, we'll just go over fundamental analysis real quick. Next week, I'll go over technical analysis. Fundamental analysis is about determining a company's intrinsic value, its true worth, by looking at financial statements, management quality, and broader factors. Unlike technical analysis, which focuses on price trends and charts, fundamental analysis digs into what really drives a business performance. The goal is to find out if a stock is undervalued, overvalued, or fairly priced, so you can buy low and sell high. And the first metric is price. The stock price is the first thing most investors see, but remember, price alone doesn't tell you if a company is a good investment. A $10 stock isn't necessarily cheaper than a $100 stock. What matters is what you're getting for that price. So always look deeper. Second, we've got earnings per share, which is EPS. EPS stands for earnings per share. It tells you how much profit a company makes for each share outstanding. It's a pretty simple formula. A rising EPS usually signals a healthy, growing company, but doesn't, we don't just need to look at 1 year. You got to check for consistent growth over time. Always pay attention to whether a company reports adjusted EPS, which excludes one-time items, to give a clearer picture of ongoing profitability. We have price to earnings ratio, which is PE. That's a big thing that I focus on in my TikTok live is P to 4P. That's one of my key evaluations. I always want to see that a company's growing. The PE ratio compares the company's share price to its earnings per share. A lower PE could mean a stock is undervalued, while a higher PE might suggest it's overvalued. Investors always want strong growth, so you've got to pay attention to these things. As a rule of thumb, a PE around 20 is considered fairly valued, but this varies by industry. Always compare a company's PE to its peers. We've got forward PE. While the regular PE looks at past earnings, the forward PE uses analyst estimates for future earnings. This gives you a sense of what the market expects. If the forward PE is much lower than the current PE, analysts are predicting strong earnings growth. And that's the main thing that you need to pay attention to when evaluating, especially growth stocks, which is mainly what I invest in. So it's a something that you always got to pay attention to every week, just making sure that it hasn't changed. You'll often find these estimates on financial news sites or brokerage platforms like Webull, Robinhood, whatever you use. You can take a quick look. When you look at a stock price, you click on, say, Nvidia or something, and if you go, you'll have the whole rundown right there on the page. You just click on the ticker symbol, and it'll go right down from price, PE, forward PE, and the rest of these metrics, such as dividend yield. Another big one that you got to pay attention to. Dividend yield shows how much cash you're getting back for each dollar invested in the form of dividends. For example, if a stock pays $1 per year in dividends and trades at $20, the yield is 5%. high yields can be attractive, but beware, sometimes high yield signals trouble if the dividend isn't sustainable over time. They're also called dividend traps. If a company is paying out a high dividend, a lot of times, they're needing the investments, basically as the stock falls in price, the dividend yield may look good, but, if it's 10% or higher, you got to beware. I mean, really anything over, unless you've got a company like Altria Group, which pays out 7%, because of its particular moat. That company gets sued a lot, so it pays out, I believe around 90% of its profits. So companies like that, that's their business model, and that's acceptable. But you just really got to be careful and pay attention to dividend safety. How safe is this dividend? How long have they been paying out this dividend? You don't want, a lot of companies change how much they pay out every few years. If the company gets in trouble, they may have to cut their dividends. So that's a big one right there. Always check the dividend safety. Make sure that you get something pick a company that's consistently paying every year and consistently increasing. And you don't want, you want to see, like I talked about in my last video about dividend stocks, that they increase their dividend yearly by at least 4% or more. That's really the standard that I would, go by. Then next, we've got the company's CEO. The company's CEO is its captain. Its CEO is responsible for its vision and drives the culture and ultimately responsible for performance. A strong visionary CEO can be a huge asset. Think of leaders like Jensen Huang of NVIDIA, Elon Musk of Tesla. They decide, where the company's headed in the future, and really, they're really responsible for the company's success as a whole. So, basically, I think that's huge. And if you don't like the company's CEO, you can always, I would personally find a company that you agree with the CEO and is confident in his decisions, because that's who ultimately decides all the big decisions. You gotta look at the CEO's track record of success, its clear communication and ability to adapt to changing markets. Leadership matters more than most investors realize. Warren Buffett just stepped down from Berkshire Hathaway, and Berkshire is actually, falling in price slightly. CEOs like the quarterback of a football team. You've got to have the MVP. So, invest wisely into the right companies with the best CEOs, and you're setting yourself up for a ton of success over time. Next, we're going to talk about the moat. A moat is what protects a company from its competitors. This could be a powerful brand, unique technology, network effects, or regulatory advantages. Companies with wide moats like Coca-Cola has brand. Google has search dominance. They tend to deliver more consistent returns over time. When analyzing a company, ask what keeps competitors at bay. Is the moat growing or shrinking? A strong moat can turn a good investment into a great one. If we just take a quick look at NVIDIA, they own 90% of the market, so they have a huge moat over their competitors. And that's really why NVIDIA is my number one investment. You know, you really can't go wrong picking companies that have solid moats. You know, that's, NVIDIA pretty much is the classic example of a great tech company which just dominates over the competition. So, but the final thoughts is you got to learn fundamental analysis to be a great investor. You know, if a company's financials are in order, over time, you're guaranteed success. Costco, for example, you know, a few years ago, I invested it at $540 a share. You know, it's now over $1,000 a share. You know, the company hadn't moved for over 6 months, sitting right there at $540. But it was obvious that it was going to because of its fundamentals. I appreciate everyone watching my video. If you found this video helpful, don't forget to hit the like and subscribe. And if you have any questions or comments, feel free to leave them in the comments below. I'll be more than happy to answer and do a deep dive into any subject or stocks you'd like me to talk about. You know, I love hearing from you. Thanks for watching Josh Delozier Investments. I'll see you all back here next week.